Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm really excited to be joined by Todd Sohn. Todd is a managing director and technical strategist at the firm. Todd, how are you doing today?
Hey Ross, I'm great. Hope you're having a nice summer.
Yeah, doing pretty good. Trying to stay cool. Hope you're having one as well. But in keeping with that, it is a bit of summer doldrums. There's not a lot of kind of big headline noise or news, but there has been kind of more subtle shifts occurring in the market. And I wanted to talk to you about what leadership looks like in the equity market right now. I want to start with sectors. I do get the sense that people think that big tech and AI, which has been the dominant narrative, is still, the main leadership in the stock market. But, over the summer, it's kind of shifted a bit. And I was wondering if you could break that down for us.
Yeah, absolutely. Tech has been phenomenal. It's clearly helped boost the market over the last 9 or 10 months. But very subtly, a lot of those names got too stretched to the upside, and you're starting to see some rotation and broadening out of participation and leadership to some of the less influential index corners, such as energy, materials, financials. I think if you are good on your tech exposure, right, you have enough big tech in your portfolio, these are the more timely areas to look at. And it's being accompanied by some reflationary pressure in commodities. But what I think stands out the most about energy is that there's really been a exodus from energy ETFs, roughly $11 billion in outflows year to date. So that suggests to me that investors have moved away from that space. And what I like is when you get equity prices rising along with that outflow, that negative sentiment. That sets up a nice contrarian play for anyone out there. So consider the more value areas here in the next few months as big tech perhaps pauses.
Yeah, and you mentioned reflationary pressure. Oil prices, commodity prices are on the rise. But I think it also comes with, some better than expected economic data and really some good momentum, at least in the domestic economy. Another big beneficiary of something like that is, moving down the cap scale, mid caps, small caps, which have been laggards again amid this run of big tech dominance. So, what are you seeing down the cap scale out of the smaller cap names?
Yeah, so I'll start you off with a statistic on the Russell 2000. It just broke a losing streak of 17 consecutive months with a rolling negative year over year return. It's a little bit of a mouthful, but when this happens historically, it is consistent with a major low for small caps, all the way back to the early 1980s when you've seen this streak end. The next year's worth of performance usually comes in above average. So if you are looking for a timely area, look at small caps. And that's more of a bet on the energy, banks, some healthcare, some industrials too. Again, more of a value tilt in some of these small cap indices. It's nothing against big tech. Tech momentum is fantastic. But if you want something more timely, look at small caps. And I think that's a great reflection of the broadening out of participation from the cap scale. That's a necessary ingredient for the durability of a bull market.
Right. And as you mentioned, totally different sector makeup down there. A lot of regional banks, a lot of energy and healthcare, as you mentioned. So, again, broadening out, looking in different corners of the market, even as big tech still gets the headlines. I want to close with a question on sentiment. So, markets have rallied, the rally has broadened out. But sentiment has followed. Sentiment tends to follow price, and people have gotten more bullish. You've noted before that equity inflows to the broader equity indices have picked up. So what are you seeing on a sentiment and positioning backdrop? And how do you utilize that data? What does that mean for you over the next, 3 to 6 months or so?
Yeah, of course. And you're approaching 10 months off the October low. Clearly, you're starting to get a whiff of FOMO. Everyone's realizing that this move has been for real. And you've seen that reflected in the pace of equity ETF inflows, right? We've had $118 billion over the last 3 months. That is meaningfully different than the last few years. I would stop short of calling this the euphoric environment that we saw back in 2020 and early 2021, right? But when sentiment starts to run hot, when the herd is thinking in the same direction, it can cause a speed bump. And you consider where some of the more influential stocks are in big tech, right? They're a little bit extended from their trend. It can set up for what I would just describe as a slight pullback, right? When sentiment gets too hot, especially from the flow data, from the survey data, that typically means you want to at least take some caution and look for a correction. I think it's a great time to zoom out and consider that the overall trend of the market is still very supportive and reflective of a cyclical bull market going on here. But tactically, just use some caution here in the next few months, perhaps to reset your portfolio and consider where you want to take your exposure to over the coming months. So sentiment running a little bit hot can be a cause, a catalyst for a correction, but we would view that one opportunistically, especially into the fourth quarter of the year.
Right. Yeah. Entering a seasonally challenging period as well, August and September, but markets have historically really been strong into year end. So I think that's great advice for folks who do operate a little more tactically. Todd, as always, tremendous to talk to you. Thank you so much for the insight, and look forward to our next chat.
Same to you, Ross. Thanks a lot.